Heavy day for earnings, and you have one that's flashing on your screens as we speak. You've got Asian Paints, which has put out its numbers. Let's take a look at the headline number, and it's a profit performance of 441 crore rupees. How does that stack up with what we were expecting? Well, much lower. The ET Now poll suggested a number of close to 550 crores at about 545 crore rupees, and even that was an uptick of a meager 2%. So I don't think the street ought to be very pleased. And you can see that sharp cash come into the stock price immediately as soon as the numbers were declared. So a consolidated profit performance of about 440 crore rupees. I'm going to try and carve out details as to what really has led to this kind of a lower number. Consolidated top line growth, though healthy for sure. 4,228 crore rupees. The street was working, or rather ET Now was working with an estimate that was a little more conservative in comparison at about 4,010 crore rupees. So 200 crore beat on the consolidated top line growth number, which is definitely probably why you're seeing a recovery in the stock price playing out. I think you can categorize this as a mixed set of numbers because I'm taking a look at the EBITDA performance, and operationally it's a miss. 743 crore rupee consolidated EBITDA versus an ET Now poll of 820 crores. So on that front, it's definitely been a lower than expected numbers. What is going to be very crucial to monitor for Asian Paints, and the number that the street will really react to or take, pay heed to, is also going to be that volume growth figure. 5 to 6% is what we are expecting. I believe we have Naveen Kulkarni with us right now. Naveen, let's take it across to you. It looks like it's a little bit of a mixed bag, but react first up to that profit and top line growth number. 440 crores consolidated profit performance with the consolidated sales at 4,228 crore rupees. How does that sit with your expectations?
Yeah, so the revenue number is slightly below our expectations, and the profit number is definitely below our expectations. I think it's got to do more with the destocking that has happened in the quarter. I think that has impacted the volume growth in this quarter.
Okay, so you would attribute it to destocking. It seems like perhaps maybe that input cost inflation as well may have worked into the operational numbers, because the EBITDA performance stands at about 743 crores, which as per our estimates is way lower, given that we were working with a number of 820 crore rupees. What do you make of a 743 crore rupee performance?
Yeah, again, it could be to do with the product mix also. So we'll have to wait and watch. We have not seen that much amount of inflation actually creeping into the business, whereas the company has had taken price hikes. So probably the gross margin should have been little better, but we'll have to wait and watch what exactly has happened on the mix in the business to gauge better, to understand better on what has happened in this quarter.
Yeah. It's not very encouraging when it comes to the decorative paint segment as well, as the company says that they have registered single-digit volume growth. The decorators business has registered low single-digit volume growth. That really isn't going to sit down well with the street. I'm taking a look at the press release as well, and they said that that's impacted largely due to the GST rollout. The material prices also have seen an upward trend, which is what has led to a squeeze in the margins this time. Mubina, who tracks the company closely, joins in with an analysis. Mubina, take it away.
Well, very disappointing numbers really across all the parameters. Like you flagged off, GST clearly seemed to have an impact on them. I think you've already said the numbers, so I'm not going to reiterate that. But yes, just to roughly say, top line growth was what we expected was Asian Paints would be a little resilient, would be able to post a good show. So that's why we were expecting. And ET Now poll was putting the growth figure at 11.7%. But what they've posted is just a meager growth of 4.9%. And mind you, this is post the price hikes that the company has undertaken in the month of March and May. So the volume growth figure, the management has said that the decorative business has been able to post low single-digit volume growth, which means that compared to what we were expecting of about 5 to 6%, that was somewhere mid-single-digit, but this is something that's low single-digit volume growth. So indeed, the number has been very, very disappointing. Remember, in the previous quarter as well, or rather in quarter 3 of demonetization, the volume growth was 2.5%. Last quarter, it bounced back and came to 11%. But this quarter, it seems that the number has been even more disappointing. What's even more surprising is that compared to the industry leader Asian Paints, its peer Kansai Nerolac has actually comparatively been able to register better growth. We just had the Q1 numbers of Kansai Nerolac, which had released a couple of days ago, and that company was able to post double-digit growth on the top line, on the EBITDA. Asian Paints has not even been able to do that. Additionally, apart from of course the dismal top line growth, even the EBITDA is very, very disappointing. We were expecting a flat EBITDA, but this one has actually compressed, and even the margins have gone down by a good 500 basis points, which has led to the net profit degrowth. Of course, the management has said that the GST is responsible for that, especially in the month of June. And additionally, of course, we have seen an increase in raw material costs, especially on a quarter-on-quarter basis, which has continued to compress the margins. International business as well, the management has said, has not been so good. So that's all the factors that have actually compressed Asian Paints. Once an industry leader, absolutely resilient when it comes to weathering all the woes, but turns out this time around, this one as well has fallen victim to with the GST transition.
Okay, Bhumina, thanks a lot for that. Asian Paints, markets will give Asian Paints that benefit of doubt, and that benefit of doubt I think is only logical. GST at dealer level, at stockist level, a lot of inventory adjustment happen. Now the way companies look at their dispatch numbers is that once shipment is out of the factory, it is considered as part of the top line or part of the revenue line. But at dealer level, there was this entire destocking which happened before GST. Now the restocking actually could happen because this time the festival season is slightly early. So Diwali, Dussehra, all the other regional festivals are slightly early. So Asian Paints may just come back and they may just surprise you. But having said that, I guess somewhere if you look at the peak growth for Asian Paints now, they are nowhere close to that peak growth. The challenge for Asian Paints has been that the cost has not come down. I'm not referring to raw material cost. I mean, raw material is an important cost, but if you are actually decorating or redecorating your home, there's a huge labor cost involvement, and that in a sense has been a big challenge for at least the first time buyers or guys who are home or redecorating the houses. The stock, it's an institutional heavy stock, and institutional investors are not going to puncture, punish or push the stock down based on one quarterly disappointment. It's a stable stock, they don't dilute, ownership doesn't change, and when stocks like Asian Paints are correct, you simply should go and buy them. Look at demonetization. I mean, stock came to sub 1000, it stayed there for a brief period of time, and then markets have taken it to its right level. It may be expensive, but markets continue to pay this premium for near-term visibility, and that is where I think Asian Paints continues to trade at that huge premium to other FMCG stock consumer staple companies.
Oh yes, indeed.
Okay, let's go to CK and let's connect with him and understand, if not 10,000 in terms of that, moment of the day. That moment is behind us. Where do we go from here? CK, for a minute, let's close our eyes. Let's close our ears. Let's filter all the noise which was centered around 10K. Let's look beyond 10K. How clearly can you look beyond 10K? 10,100, 10,200. Guess what, CK? I'm also training my tongue to start using that 10,000 terminology now.
Yeah, I think, like you said, if you close your eyes and ears, then you'll truly be able to concentrate on what is the real deal here, which is the trend. And the trend has been completely unbiased in the sense that it's resolutely stuck to one direction, which is up. Now 10,000 having been achieved and the trend showing no signs of wilting, I think it would be fair game to state that it should continue, and 10,100, 200, etc. that you mentioned, I think those all should be easily achievable. My expectation is that it would run along, because the next, at newer highs, you have to have some calculations or projected levels of supply zones. Now that is coming very comfortably further away, somewhere around 10,550. So we are looking at a sizable advance, if the market were to persist with the higher levels. So I don't think we should think in terms of 100, 200 points here. As you go higher, the dominoes, they kind of start rolling on for longer. So I would aim even higher than what you just mentioned.
Siddharth Bhambre, are you actually going on a 2-week holiday? to cycle in and around London. Is that true?
Well, I'm going for a 2 weeks sports tour, then that's what I'm calling it, where I'll be cycling around 1400 kilometers from London to Edinburgh and back to London. And after finishing that, I'm going to Poland for half Ironman. So yeah, looking forward for it from tomorrow.
Are you getting a bit of a complex? Because I mean, hearing that, Nikunj, that requires a lot of strength and a lot of determination. So kudos to that from all of us.
A supportive wife as well.
Oh yes, of course. Yeah,
which is very, very important.
For now, there's no support for the markets. Absolutely. Of course, it was a great morning that we started off with. Siddharth, let's talk about the index for a change, and what's your outlook on the markets at the current juncture, banks in particular?
Well, I really got a wonderful and very supportive wife, just to answer Nikunj's curiosity. Yes, markets are in, quite fine, and we are seeing, some of the traders now lapping up to 10,000 call options. And that's the reason you are seeing around 21,000 contracts built up over there, which I was highlighting in my plasma. But I believe these are mainly those traders who are anticipating any major run up in this market on back of short covering. Now, this would be a thought process that, okay, 10,000 is here, lot of shorts will start getting covered and market would rally. I have missed out, let me buy 10,000 call option and capture some of this up move in last 2 trading session. I guess that won't happen. We might gyrate around 10,000. Having said that, if we are gyrating around 10,000 and if we are not going up in next 2 trading sessions significantly, that doesn't mean the correction would come. Shorts might be there in system, but those shorts are in stocks and not in, indices. Nifty has seen reduction of open interest, Bank Nifty has seen formation of long positions. So there is no scope for big short covering in indices. And stocks, we have seen mixed positions. So some of the stocks go up, some of the stock goes down, and the index remains there. So I believe for next 2 trading session, don't expect big move in indices on the upside, but certainly correction is also not coming.
Okay. Manas, let me get your stock idea going.
2 buy recommendations. First is Jubilant Food again, because yes, we saw a smart rally from the level of 900 to 1300, but in last 3-4 trading sessions we saw some correction from high levels. But now again today we saw a lot of buying interest at lower levels. I think the rally will resume soon, and Jubilant Food can test 1400 in next 1 or 2 trading sessions. So here one can take a long call, keep the stop loss below 1245. And second is Apollo Tyres, because stock was facing a lot of resistance near to 260 for last 1 month, and today it has broken that resistance with higher volumes. So this is a clear breakout case, and after this breakout you can expect the target of around 272. So here one can take a long call with a stop loss of 256.
Nifty at 10K, we are celebrating that moment, even though traders are not able to savor it for long, because it was like this touch and go moment at 9:15 and then Nifty came down. But let's get on. Let me bring on board S. Naren of ICICI Prudential AMC, someone who I always like to call him as a contra investor. He hates periods like he hates current market because the current market is euphoric and it does not give him too many options to invest. So Naren, we may want to start this interview with a warm smile on your face because Nifty has reached a landmark. But for a typical investor who believes in contra investing, this must be a terrible and a horrible time because everything is euphoric.
Clearly, if investors suddenly decide that I'm going to invest big money in equity today, I don't think you're investing cheap. So while Nikunj can celebrate 10,000 Nifty, I think to make money, you actually make more money by investing cheap. So that's the reality.
So let's talk about 2 pockets, Naren. Let's talk about a pocket where you think there is definitely, if not a bubble or a bust, but definitely there is a lot of mispricing and markets are overestimating the earnings recovery. That's part A of my question. Part B of my question, the reverse of that. Where do you think markets are underestimating the potential of earnings recovery and there is too much of pessimism and too much of fear?
See, if you look at pockets of pessimism, there are only 3 pockets of pessimism. Some of the PSU banks, pharma and technology. These are the only 3 pockets of pessimism I can see. Other than these three, there are no pockets of pessimism. The reality, if the IT industry has shown, is that the sector is slowing down. It's difficult to grow the sector at the same pace that it used to. So are the stocks priced for that? It appears to be more or less priced for that. But at this point of time, there's no evidence to say that growth rates in IT industry are shooting up. So if you look at pharmaceutical industry, again, there is a situation where there are individual problems due to FDA in many companies. So, and I think over the next 12 to 24 months, some of these companies will come out of their problems, and that would cause a decent pop in each of those individual stocks. So you'll have to buy, wait patiently and wait for the FDA problem to get resolved in that company, and you have returns coming. Whether you can time it to perfection, the answer is no. Do you think that in the next 2 years they'll be able to solve the problems? Certainly. So that's how we look at pharmaceutical. In PSU banks, clearly if the NPL issue comes under control, clearly again there is scope for these stocks to go up. But other than these three pockets, I would say there is nothing cheap at this point of time. We spend all our time looking at them, but nothing appears to be cheap at this point of time.
Okay, point taken, Naren. And on a day in which we've made history, perhaps, you know, I wanted to try and echo some positive comments for you. What about the earnings growth? I mean, you'd have to agree to the fact that despite it being a bit of a mixed bag, there have been more positive than negatives, or at least it's been neutral rather than the negative surprises coming in. So what has been your outlook on the overall earnings season? Do you think that the markets have been well aligned to the earnings expectations?
See, clearly, I think I'm a believer earnings will come in the next 2 years. So I am really not worried about earnings. There are a lot of people who worry about earnings and capex cycle. But I believe that both earnings and capex cycle will happen in the next 2 years. And which quarter it is where the earnings show a broad-based growth, it's difficult for me to predict. But I think it will happen maybe December quarter or somewhat or later than that. But it will happen. So I don't think we are in a situation where we should be pessimistic at this point of time. At the same time, you know, when the market is at 10,000, one of the lessons, see, I go back and look at my experiences in the market, and my view is that this market resembles 94, 95. That was the first bull market where FIs were allowed entry into India. And you had a massive liquidity boom from FIs, just like what we are seeing is a big liquidity boom from local investors in this cycle. So what did I learn from 94-95 boom? I learned from 94-95 boom that you will have to actually implement asset allocation. Once the market goes into bull frenzy, you have to practice asset allocation. What do I as a CIO do to practice asset allocation? We recommend dynamic asset allocation products, balanced advantage, equity income, balance, these kind of products. That's my learning from 94-95. What is the second learning that I learned from 94-95 was that you don't move from good quality companies to bad quality companies just because they're cheap on price to earnings or price to book or things like that. So that is something we as a house are trying to avoid at this point of time, and we have a lot of debate within the company because the best quality companies have become pretty costly and now you're tempted to buy the cheaper companies. So that's a debate which we are having. The third is that, you know, you can't believe that you will actually get an exit on the way down. In 94-95 boom, no one got an exit on the way down. So I believe that it's very important to maintain your asset allocation in equity. But if people think that they will be the last person correctly exiting the markets, that's not going to happen. So what does asset allocation mean is that you actually maintain a certain fixed part of your net worth into equity in this cycle. So this is how I have learned from 94-95 cycle, and that is what as a company we are trying to communicate to investors, that equities is not a riskless asset class. But having said that, there's nothing to worry about the earnings cycle at this point of time. There's nothing to worry about capex cycle at this point of time. And we think that the top of the earnings cycle is maybe a year or two away.
So Naren, I'm going to take a leaf off our last interaction, and you beautifully put the market could be divided into 4 parts: best, boom, bubble, and then bust. So best is behind us, boom is where we are. So before we move from boom to bubble, how much more do you think we need to travel?
Yeah. So actually we spent a lot of time debating this issue, and clearly what came out of our analysis is, in a bubble 2 things happen. One is, as a mutual fund industry, we start collecting money in theme funds. If you look at the last 2 bubbles, you collected money in infrastructure in 2007 and technology in 1999. So we think that once it reaches a bubble, you will start getting money in a theme fund. The second, what we have learnt is that from 1999, 2007, 1992 and later, in 1992 you had replacement cost theory of valuing assets. In 1999 you had eyeball method of valuing assets. In 2007 you had land bank model of valuing companies, and in 2014 when the e-commerce bubble took shape, we had gross merchandise value model of valuing companies. So in the last phase of the cycle, you have a top line based valuation model. So the 2 things which have not happened are the 2 T's. One is that you have not yet started getting money in a theme fund, and you have still not seen a top line based valuation model. So I think the moment these 2 come, then you have to alert yourself to the fact that you've reached the bubble phase of the market. So that's why I would say we are still in boom phase. Maybe we are in the second half of the boom phase, but we are not yet in bubble phase.
Your sales team or maybe your CEO to find out when are they planning a theme fund, right? The minute ICICI Prudential plans a theme fund, it's time to get out, right?
See, it doesn't need to happen with the theme fund. It happens also with the all of a sudden you had infrastructure funds collecting all the money in 2007. So it doesn't need to happen just due to a launch. It can happen due to big inflows in one thematic category as well.
Okay.
Let's also get in then another expert into the market discussion in just a bit. We will be having Sunil Singhania will be joining in. But in the meantime, Naren, what is the outlook when it comes to, the kind of movement that we've seen in the broader end of the market? Are you convinced by the kind of up move, although it perhaps might not have been at par with the frontliners? What are you advising clients when it comes to the broader end of the market? How does one really cushion the volatility?
See, we are reasonably clear that the best way to cushion volatility is to invest in dynamic asset allocation category. And we have been believers over the last 1 year that small caps and mid caps are both costlier relative to large caps. It's only in the last 3 months that large caps have done much better than both mid caps and small caps. And so for the last 3 months, we are smiling on that area. But otherwise, I would say, today we are not in a situation where we can either say that small caps or mid caps are cheap. And I think the best way to invest from now on is to invest in dynamic asset allocation categories, funds which have a fair amount of debt or arbitrage in them. Those are the kind of funds to actually invest in at this point of time.
Okay. Naren, let's talk about pocket of consensus. And the pocket of consensus in this market, I think there are like 2 large pockets where there is consensus buy. One is private sector banks, and second, I would imagine it is consumer staples. They're expensive, yet the consensus there is still buy. So would you avoid these 2 large consensus dominated sectors?
So I don't think it's possible to construct a portfolio today without having private sector banks, and almost 30-35% of the benchmark is banking. So it's impossible to construct a portfolio without private sector banks. And we also think that if we look at the next 10 years, the outlook for private sector banks continues to be good. And many of the private sector banks have valuable subsidiaries in insurance, asset management and various other areas, which will also help the entire outlook for private sector banks. On consumer staples, lately we were a bit positive, but now again the valuations has gone back to stratospheric levels even relative to the market. So we've gone back to a situation where we've found the sector costly, but there have been times when while we have found a sector costly, the sector continues to do well. At least one of the advantages of the consumer staple names is there doesn't seem to be any big risk of disruption in that sector, whereas in many of the other areas in the market, we actually have to worry about disruption risks, and that risk doesn't exist with the staples.
Okay. You know, in a previous conversation with us, Naren, you had spoken about the outlook for telecom, talking about how over the long haul, the outlook looks very promising, but perhaps in the short term, it's difficult to really take a call. You know, give us that compelling argument as to why you believe in the long run, telecom makes for a good place to be.
So if I separate you from a mobile phone for 4 hours and ask you how's the feeling, do you miss your purse or do you miss the mobile phone, and you answer it truthfully, I think I've given you the answer.
You've been spending a lot of time analyzing what Indian women are doing. That's how you know the answer, the difference between purse and a mobile phone.
So actually, there is a book written that Warren Buffett invests like a woman or something like that. I believe that very often we sitting in our offices forget that markets are made up of customers, and what customers do, if you actually do that, you actually make more money. Like if you look at it, all the people who realized that scooters were doing much better than mobiles, they were the people who made most of the money in stock market. In that area. So I think it's very important for us to track what customers are up
to. We won't get into any specific more observations you've had about consumer patterns, but I'd like to just scan through your portfolio, and I do see that utilities still have a big ownership there, especially power grid. Now the bet to buy utilities couple of years ago was interest rates will come down, you buy utilities. It's a business which will benefit if interest rates come down. That large interest rate cut is now behind us. Does it make sense to still buy into utilities or companies which will benefit when interest rates will come down?
We still believe interest rates could come down from here as well. If you look at the inflation numbers, the kind of credit growth which exists at this point of time, there is scope for interest rates to come down from here. I think once we come to a situation where the interest rate cycle is over, I think clearly we will have to look at our utilities position.
Naren,
otherwise, I think we continue to like it.
Okay, so Naren, closing comments from you. We've extended our appointment with you, and before I get messages from your communication department that you need to go back to your meeting, I'll wrap the discussion. So let me define that. Let me define the time frame here. Next 1 year, 3 year, and 5 year. Which is one category you think has potential to give maximum returns? 1, 3, and 5.
See, we had done some work, and we will share that work with you. At the level of valuations we are in, it's interesting to see that the best outlook is for 5 years. And then 1 year, and the worst outlook is for 3 years. This is what our research work at this stage of valuation, when you invest, we found that it is the 3-year return which is most suspect at this point of time. And we'll be happy to send you that data, because it's quite interesting to see when the markets are valued where we are today. It is the 3-year outlook which we have to worry about, and not the 5-year outlook, and not so much the 1-year outlook, because in the next 1 year you could see earnings coming and markets continuing to re-rate, but it's the 3-year outlook where you have to be most cautious on.
Appreciate your time. Thank you for joining us. And before we take a break, and then we will connect with Sunil Singhania, he's just getting warmed up and ready. And I'm just going to go to our technical experts to get some trading ideas. And I just noticed on my screen that Shriram Transport is making a comeback. Technically, how's that one looking, Manas?
Definitely, you may see some more recovery. We have already seen a crack from the level of 1150 to 950. So it is almost 200 rupees fall. So I think stock can correct a little bit more. Stock can test around 1040, 1050. So if you're a trader and you can keep the stop loss, then definitely here you can take a long call with a stop loss of 970.
Okay, what about your 255 idea, Manas?
It would be Hindalco because on the long term charts we have seen a breakout near to 210. For last 3 trading sessions, the stock was facing a resistance near to 216 and today it broke that resistance. So I think as a BTST, as a 1 or 2 days, definitely here one can take a long call with a stop loss of 214. Target would be around 230, 232.
Okay, Dr. Narayan, your idea?
Well, I would buy into a Federal Bank at this juncture. Seems to be setting up for some fresh up moves. 119 current price. Can look for 125 as the immediate target. Stop loss at 116.
Okay, Federal Bank it is. And finally, Siddharth, what is your top call?
Well, United Phosphorus, we haven't spoken since quite some time because the stock was consolidating since last 2-3 weeks, and before that there was a mild correction from 880 to 820 odd levels or so. And in today's trading session, cash volumes are double of average volumes, already crossed 20 lakhs mark, and we are seeing positive built up in FNO. Stock is on verge of giving a breakout above this 885, 890 resistance zone. Easily it can move towards 956, fix a stop loss of 865 and go long in UPL.
Okay, that's a view coming in on all the top 255 recommendations to watch out for. Time to slip into a short break. Stay with us. The markets have managed to recover from the intraday lows. 99.76 on last tick. Get you lots more market perspective and big voices on ET Now.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.